My guest today is Jesper Søgaard, a co-founder and CEO of Better Collective, a leading digital sports media, sports betting media, and esport and gaming communities with a portfolio of more than 11 media brands, including SoccerNews, Action Network, HLTV, and others. Thanks a lot for coming to the podcast, Jesper.
Thanks a lot for inviting me.
You co-founded the business back in 2004. Today, you have more than 1,200 talented employees, 20 international offices, and nearly 400 million monthly visits across its portfolio. You've had very busy 2 decades, but where did it all start? Take us back to what were you doing before founding Better Collective?
Well, actually, so 2004 was the incorporation of the company, but my co-founder Christian Kirk Rasmussen and I, we actually had a gap year after high school in 2002, and that's where the small seed for the company was planted, basically based on the affiliate business model within at that time online casino and sharing sort of bonus tips and strategies. And at the time we had ourselves learned sort of how you could actually wager and sort of be smart about the blackjack strategy and optimize your winnings that way and go to the next one, collect the bonus and so forth. So a way where it was explained how you could actually outsmart the casino. It's not possible anymore, but there was that short loophole at the time, which got us into the industry. And when we had that gap year in Berlin, where we moved to Berlin, we basically created a small German portal explaining this to the German population. It became a big thing in Denmark, and we then did that in Germany. That was the small seed. That was sort of us doing a website that then led to a few years later that we incorporated the company actually under a different name. At the time we changed rebranded the name around 2011. That's sort of the founding story, where Christian, he brought a couple of laptops to the hostel we were staying in Berlin, and then we sat with the German dictionary to come up with a name for that website. So I think it's as close to a true garage story that it could be.
And how would you sum up the first 5 years? From which moment you maybe realized that, okay, this could be a very large business, or it was just a small organic growth, or how was it?
Yeah, it was the latter. So we started and we moved to Copenhagen, started studying. So I have a master's degree in political science. So while we were studying, we were working with sort of our first small websites, and it was very much the slow version. Revenues were very limited in the beginning, and had we been a venture backed company and finance company, I'm not sure we would have made it, because the first 3 years we didn't see much development in the performance of the company. But I think what did change the business was when we were finished with our bachelor degree, which is then roughly 3 years after the incorporation. We took a year with dedicated focus on the company rather than the studies. And that's where we sort of lifted the audience performance and revenue performance. So it all of a sudden could pay 2 full-time salaries, even with the surplus. And I think that was the point. And we are now in 2006. That was the year where we considered, okay, we're onto something here. It really has that scalable potential, and we have no cost. It's just the two of us, and actually Christian's little brother helping out a bit as well. So we continued on that journey a few years when I finished then my master degree. And then we reached the pivotal point, I would say, in 2009, where there was actually proper revenue. We talked something like 1.3 million euros revenue of sort of that last year in 2009. And we started employing people. We got a proper office, and not in the first years we were sharing a flat, and we sat in that flat working together. So it was really 2009 is where I at least think that's where we became a real company with a outside office. We started employing people, and at the end of 2009, I think we were 10 colleagues in the company. So until 2009, it was quite a lot of scrambling and just us. And then we became a proper company from 2009 and onwards.
And looking back, maybe reading about other stories, other businesses, talking to other entrepreneurs, was it like a very hard, like thinking back, or you were just in your 20s having fun, once in a while working long hours, you were still having fun on the weekends, or it was more like a serious grind and hustle?
No, it was the fun and us not knowing what we were doing really, but just living that free life that you have in your 20s, where you don't consider it work. Like honestly, that's when I look back, I can see a lot of stuff that today, yes, that would be work because it will take time away from my family, and but back then when it was just me, I did not consider it work. So my feeling was, no, it wasn't sort of that crazy grind, and we had to give up a lot, and it was a horrible, tough experience. No, that's not how I view it. It was more just what we liked doing, what we basically just filled our life with was somehow also related to the company. Didn't consider it work necessarily.
And how about the partnership? You've been doing it for more than 20 years now with Christian. How was the early days? And what I mean more is like strengths and weaknesses. What were you doing? What was he doing? Your strengths, your weaknesses, and Christian's strengths and weaknesses.
Yeah, so we have very clear personal profiles. I think when we have been doing personal assessment, we are basically mirror images of each other. So complete opposite, but when you fold them together, they fit. And I think the what has been very fortunate for us is that we have sort of a shared set of values. We are both fairly calm and are not in need of it has to be my way and no other. Like we both of us are not like that. But from a personality and skill set perspective, we are very different. So Christian is much more the detail kind of guy who will know the ins and out of everything we do. Like and basically can jump into each part and have a very qualified view on many details. And I'm more the opposite. I'm more the big lines kind of guy, and the stakeholder person, meaning I really consider how do we position Better Collective in an ecosystem? How do we engage with stakeholders, and what do we need to sort of consider for taking the next step in the company's development? And you can probably hear that Christian's skill set was more attuned to the early days of the company than my skill set. But still, I think where I could then also add a lot of value in the early days was helping build network and drive opportunities that came our way by being very outgoing. So we have from more or less day one been quite certain about the roles and capabilities we each had, and it has very much been so ever since. We have also a shared mindset of thinking long term, and sort of that's what we care about. And we have gotten ourselves involved in also other things than Better Collective, and we do so with a 50-50 mindset. So today in Better Collective, we own exactly the same number of shares, and everything we engage with, apart from buying say a Microsoft share or Alphabet share, like obviously we will just do that. But if we are investing in a private company, we would sort of discuss that. Okay, do you want to be part of this? And in almost all cases, we do that together, 50-50. So we're fully aligned in that sense, which I think is quite unusual. There are not that many sort of founders that after 20 years are that sort of aligned and basically involved in the same sense in all the activities that we do. It gives us a lot of strength. Of course, it requires the willingness to be flexible, because sometimes it's more Christian's way if he have a certain opinion, and I sort of accommodate that. And in other cases, it's the other way around. So it does require that willingness to say, okay, this is not that important for me, and it's important for Christians. So yeah, I support that. Let's do it. And that goes both ways.
Yes, it is rare. It is unusual. Do you sometimes get tired of each other? Do you hang around outside of work as well, or it's just in the office and it's all good? And then, as you said, you're quite different in that sense. So once the work ends, you're going home. Do you still texting each other, hanging around with families, or it's just work?
Well, it is in mostly work. We will occasionally see each other in private settings, and we also have a lot of shared friends. So see that, but no, it's not like then. Okay, this Sunday I'll just come by you, Chris, and I could easily do that. It's like, but no, I think we just have so much where we are together and sort of in a shared setting. And we both live lives with then families and other friends. So no, it's in the private sense. It's not that often that we come together. But then on the other hand, we had our 40th birthday a couple of years ago, and there we hosted a big party together, like private party together, because we have so many shared friends. So might as well just have it together. So in that sense, it's not at all complicated, but I think we're just busy with our own families and those friends we also have individually today.
Okay. And when it comes to the timeline, 2009, you said you had 10 colleagues. What happened then? You were still growing organically. At which moment you decided that, okay, we should maybe expand quicker, faster by acquiring competitor or entering into another market, or how was this period?
We actually had so from 2009 and up until 2017, it was a pure organic growth at that time we were in Europe, developing these sports betting media brands and communities for different European markets and sort of developing the existing ones, and saw a lot of success with that. What we then realized was that I think starting in 2014, there were some of our competitors that started to buy businesses in our space. Some of them more focused on sort of the casino part, but basically based on the affiliate business model, they started to acquire businesses. And I think in the beginning we thought, well, does that make sense? No, I will just keep being focused on what we do and grow organically. But then there was also the realization that, wow, they're getting quite big, and basically, can we stay competitive if we don't reach a similar scale as they are getting? And from a sort of customer perspective, how relevant will we be with our customers and the offerings we have if we will be subscale in our business and not be able to go to many different geographies? So it definitely sparked that consideration at the time. And we had just in 2015, I think we for the first time formulated sort of a proper strategy, which we called Accomplish 2019. Which set out some directions for the development of the business in one part, a professionalization. So basically upping the skill sets and processes in the company. And secondly, also setting some quite ambitious targets for how we wanted to develop the company financially. And the guiding star for that was that we wanted to be in a position in 2019 so we could potentially list the company in the public markets, because we knew, okay, if we are to achieve that, we need to be bigger and we need to basically get the house in order. And it was not like we then wanted to list the company necessarily, because that would require a need for capital, which we did not have at the time. But then when we saw these competitors buy businesses, we gradually saw, okay, if we consider our niche and some of the local competitors we face, where there were some great ones, like in some of the local language markets, so German speaking or in the Greek market as well. We saw some really great brands and products that have been developed, and that's where we started. Okay, if we could acquire those businesses, that they would definitely add to sort of our platform and our opportunities. So the realization came in 2016 that would make sense, and we then did our first acquisition in 2017, and quite rapidly saw success with that, both in the aspect that we acquired at a very attractive price. So at the time, paying 4 to 5 times earnings before tax, which in a growing market, that's a pretty good price. And we could also see we could actually harvest some synergies. So the other aspect of that was that it also gave us that scale we believe would be beneficial towards our customers, and we could, from a customer perspective, often having sort of better commercials, we could actually lift the performance of the acquired brands. So it made sense, and it worked. And we realized that, okay, we have been using the cash flow and a debt facility to make those acquisitions. And so the next step was, okay, now it actually makes sense to do an IPO and raise funds for the company for the first time. So that led to us actually accomplished 2019 1 year ahead of schedule. So in 2018, we actually did the IPO on the main market of Nasdaq Stockholm and raised approximately 65 million euros in proceeds that we then used to continue the M&A strategy.
Okay, and in terms of revenue streams, how has it changed over time? Let's say till 2017, when you made the first acquisition, how much has it changed in what type of new, maybe industries, if I can say that, markets you've entered, and how has it changed?
Yeah, so it has changed quite a bit. So yeah, let me put some numbers to that. So we started out in the affiliate space, so the affiliate one, meaning that we have been paid by predominantly sports books by delivering customers. So a performance-based model where they pay us on performance. That was sort of 100% of our revenue back in the day. It was that model we applied. And as I said earlier, we were a European business, so we have 100% of our revenue from Europe. On the back of the IPO, and also we actually had, at the IPO, we had our single biggest customer accounting for 50% of our revenue. So a very big customer concentration. So since then, we have developed and added sort of general advertising sales. We have added subscription business. We have also a sponsorship business led by talent-led media, so podcast shows, YouTube shows, etc. So now we are at a point where roughly still the performance part business is very big, but more to the tune of 75% of our business, and then the remainder in different business areas. And then we have, secondly, from a geographical perspective, we have developed North America, we've developed South America. So Europe is probably now below 50% of our business, and the customer concentration has gone down also significantly. So we are down to the tune of maybe 25%. So it like from many aspects, we have been able to develop the business quite a bit with this sort of platform that we have gotten from M&A, been able to acquire a lot of businesses, And the expansion to North America was led by acquisitions. And in South America, we also managed to get a foothold of being sort of the biggest digital sports media group in South America because of acquisitions. So it has really been instrumental to the development and expansion of Better Collective.
The growth through acquisition strategy, looking back, do you wish you have started it earlier, seeing how successful it's been? Because since 2017, you've done like 35 acquisitions, if I'm correct.
Yeah. Yes, I think is the short answer. That at least has been sort of the discussion I've had with Christian sometimes, is because what we realized was that prices were even lower, sort of in some years prior to us starting, and there's then the balance of the size we had. Were we able to finance acquisitions of all of that? So it's not like I sit today thinking, okay, it would have made a huge difference had we started 2 or 3 years earlier. But I think it would have made sense. But whether it would have been a sort of a really a needle mover, I don't know. But yes, we immediately saw success. And I think the trend has been that if things were like the business were even cheaper in the earlier years.
And how has been the strategy when looking for the first acquisitions? Did you go for those smaller players, or you decided to buy a large one like a platform, and then you started doing those add-ons, or how has it been?
Yes, so when we started out, it was we also had a lot to learn, because we did not have as you allude to now, like, are you buying a platform and then bolt on, and like, which I would think about today. We did not think it like that at the time. We thought, okay, is this a good brand for this market? Can we buy it at an attractive price? That's interesting. We'll do that. So that's where it started. But obviously we also there was a difference in size of the acquisitions, and we fairly quickly learned that there has to be very good reasons for buying something small, because it would require quite a lot of work still, and you're basically not getting such big rewards for doing that work when it's a small acquisition. And there can, of course, be something like a strategic unlock by doing a small. So I would not rule it out, but it's just from sort of the learnings, small versus big, then I will go for big. That's sort of the rule of thumb.
And how about the synergies? Asking because trying to understand the post-acquisition game. Like, do the seller, do they stay on? They join you as a group, or they prefer to sell 100%? You're happy to buying it all and just take over? How has it been?
We've actually had I think almost all different models that you just described there. So we have had business where we just acquired it with a short handover period of 3 to 6 months, and then we own it, control it, and quickly integrate it to our own ways of working. Then we have had businesses where we moved into maybe a new business area. We can mention, like within esports, when we acquired HLTV, which is sort of the biggest brand within community and news in CS2. There we retained the founders because it was, for us, clearly sort of a different kind of business, and wanted to basically make sure that this very well-performing business, we should not rock the boat there. It should continue. We should support and ideally amplify the activities they were doing. So there we created an earnout. They also got some shares in Better Collective, and of course a cash sum with the acquisition. But a 3-year earnout, really just to sort of make sure that, okay, you will work with this and develop it. So, and actually it has turned out that now, like Martin and Per, they are and Pisa are out of the earnout, and they are now like part of BC, and they have the same responsibilities. They really set the direction for HLTV, and we support them because we are like they're just doing a fantastic job, and we just want them to be as ambitious about that brand as possible, because it holds a lot of potential, and them as founders are best positioned to realize that potential.
35 acquisitions, that's a lot. So have things gone as planned always with those acquisitions, or there are some...
You could probably guess the answer to that. Obviously, there have been acquisitions that did not go as we planned and hoped. And I think back to the lesson of small versus big, the problem with smaller ones is also that you end up not giving them enough attention and care. So that is just a good reason for buying something big, because you are more focused on making that perform, because it's simply it's a much bigger loss if it doesn't go as planned. We have experience also with sort of a bigger acquisition where we unfortunately realized that we had not bought as solid a business as we thought. So basics are more on the due diligence side, where we learned a lot. But when I then consider the net of all acquisitions, it has really created a lot of value for Better Collective, and from an expansion and positioning perspective, as I alluded to, we were just here, and now we have a very strong platform for growth in North America and the same in South America. And that is because of the acquisitions we have done. So they have been instrumental in positioning us with an attractive position in a long-term growth sector within digital sports media and the digital sports betting market, where we think we still have so much to unlock in the coming years. So some of these acquisitions, they've also been about land grab, making sure we got that footprint that for the next 10 years will drive growth for the company. So yes, there have been a few flunks, which I think just is part of the game when you buy as many businesses as we have done. But the net from a financial perspective have been attractive, and also from, I would almost say most importantly, from sort of setting ourselves up for long-term success. It has been crucial in getting these footholds in important parts of the world.
When it comes to those small and big acquisitions, what are you after usually? Is it traffic? Is it people? Is it revenue?
It will vary. We have bought some businesses based on the affiliate business model, so similar business to where we came from. They have off-case been, I would call, quite obvious financial acquisitions, where we could buy them at a very attractive price, and then we could realize synergies. Often we could improve audience growth by helping improve search engine optimization. With our deals with our partners, we could lift the immediate revenue performance of stuff. And then it's sort of on the back of that, we harvest those. It's a fairly stable brand or asset that is where the payback period is just short. So businesses that are not, they're not putting us in a new strategic direction or unlocking a big sort of potential, but they are just very solid, financially attractive deals. And then we have take HLTV, where we move into a new category, being sort of esports, where we have acquired the leading brand and an asset. And that has really sort of unlocked a new business opportunity for the company, where the business model also was 100% ads-based. So giving a new revenue stream to the company, and a very strong audience and brand that we can then build upon, where we have natural tailwind in the development of that brand. So again, quite different sort of rationales for the different acquisitions. And also from a price perspective, HLTV was a higher multiple. It was more to the tune of 10 times EBITDA when we acquired that business. And I think when we look at Better Collective, we come from sort of the affiliate business model, which we have applied successfully in many realms, and as we have acquired more and more digital sports media, it's more of an ads business where we then also utilize the expertise that we have from the affiliate business model, coupled with sort of audience growth from the SEO capabilities. And then, due to the reach and size we have today, where we're now more than 400 million monthly visits across all these brands, we are then gradually reaching sort of a new scale advantage, where we also from the content side can sort of utilize content production from different brands that can be relevant to other regions and other brands. So we are now seeing sort of new synergies starting to rise with the scale.
And how has your role and maybe Christian's roles changed over time? Doing all those acquisitions, growing a lot. I mean, 400 million monthly visits. I'm asking because trying to also, like, how has it been your personal growth and what type, like some type of cycles along this long journey?
Yeah, so I think it probably equates to every, I don't know, second or third or fourth year to get a new job. Just if we go all the way back, there was sort of the change from just being these guys in our flat trying to set up a website and hustle a bit around with making deals and drive a small business there, to a few years later, okay, now we are employing people. We all of a sudden have a small organization of 10 people that we need to be the leader for that. So that was sort of a new job, speaking especially for me. Then when you got to say the 50 or 60 employees, and all of a sudden you need to create a new layer of management. Again, that changes the role, and it is sort of a new role of leading leaders. And then we start to buy businesses. Again, quite a new development and task of the job and the requirements of the position. Then the IPO, and I could keep on mentioning these things where it's a pretty radical change, which you adapt to. And I think for me personally, that has been catering well to my personality, that I would not function well in the same job with no development for a long time period of time. So I felt that as something rewarding. I think at times for Christian, being so focused on the operations and detail, especially in sort of the early days, he had to develop that skill of, okay, now I'm gonna, like, others are driving this forward, and I will have sort of less hands-on approach. Today, where he's now sort of having huge teams and colleagues under him, but still sort of running the operations. So it has definitely been sort of a transformational development, and very, very different roles over time, and from my perspective, very different stakeholders that I had to engage with.
What about your thought process behind buying a business? What I mean is, how do you decide whether to buy internally, partner, or acquire when expanding this media portfolio you have?
It's the way we navigate that. So for us, obviously, our business is in the digital sports media space. That's sort of where we start. So sports and in a digital version, and then we consider, so the business we look at, how big an impact can we actually make with our business, and how, so is it a sole sports business? Is it a pure digital sports media? Then yeah, it's relevant. We can make a big difference. We're a relevant owner. If you consider something less of, like, take a more traditional media that will have some sport, but it will also have politics and other stuff, well, the part of the business we will be affecting is just much smaller. So no, that's not relevant from an owner context for us, but there could be collaborations, because they still have some area that is relevant to us. So that's actually how we navigate. And then another part is then we care a lot about brands. We really want to find proper brands. And then you have a lot of behavioral metrics that will indicate whether or not this website is a true brand. And you probably know it from yourself, Mick, that you will have sort of a handful, maybe up to 10 apps or websites that you go every day and you don't consider it. You just open the smartphone and you go there, or if you're a laptop, you just type in the URL and you don't even think about it. It's all in the fingers, just type it and you go there because that's just like you have your morning coffee. It's so natural for you to do that. Such brands are what we ideally would like to own, where you have such a passionate audience that without thinking, they go there. Because that's a very, very powerful position to have, and something where, from a sustainability and long-term perspective, you really have something solid where you can amplify the development of that brand. So that's how we think about targets and acquisitions.
I want to talk about capital allocation because you've grown into a phase where I think it's getting more and more interesting, and with the EBITDA exceeding 111 million euros, how do you approach capital allocation within Better Collective? Because you have this extremely long-term. You've come a long way, but I'm sure you, as you said, you just turned 40. You have a long way ahead of you. So what's your thought process when it comes to capital allocation?
We have the luxury in our business that we have a strong free cash flow. This year we got a strong free cash flow of 55 to 75 million euros. So it comes with quite a bit of responsibility to make sure that we use that cash flow in the most value creating way for the shareholders of Better Collective. And Christian and me still being the biggest shareholders of Better Collective, obviously it's something that is very it gets a lot of attention from us. And when you do talk M&A, I at least believe you always need to consider your options of buying. So you need to consider what are the price tags and valuations in the landscape of the potential targets you have. And we, of course, we've bought a lot of businesses in the private markets where you have less transparency about price levels, and you don't have similar reactions to, say, macro trends or price developments as you will see in the public markets. And therefore, it does mean that you really need to consider when is sort of a more opportune time for you to potentially buy in the private markets versus public markets versus Betco stock, which is, that is equal to us buying the businesses we have bought again. If and therefore, when I consider this free cash flow, I basically look at the attractiveness of businesses we can buy at the price levels. How is the public market? How is that being priced? And then how is Better Collective being priced? And basically consider what is the most attractive and most value creating for shareholders of Better Collective to buy. And that is coupled then also with a focus on our internal projects, where when we allocate cash flow to new developments in Better Collective, we obviously need to consider how attractive are these compared to all the other options we have that I just described, where we can allocate that cash flow. And I think historically we have both, we have several times tapped the market to raise new capital. We have had share buyback programs. We have used bought back shares to buy businesses. So I think we have quite a bit of flexibility in the capital allocation, and it's actually our responsibility to use that flexibility in a value creating way for the shareholders of Better Collective.
And maybe going more in depth, what are your criteria for reinvesting those profits versus distributing them to your shareholders?
Since the IPO, we were very clear about the M&A strategy, and it has, and we've had so much opportunity with acquiring businesses and sort of moving to new markets. So it is a more recent thing for us to sort of really consider the other options and basically expected rate of return for different projects and not just focus on buying businesses. I think right now we have also, because we have seen a significant share price decline in Better Collective, it basically ups the bar of different like other ways to allocate cash flow than basically not to buy shares in Better Collective. So it's back to the part that it will change over time. But right now we are in a phase where we really need to consider how do we create the most value for shareholders with sort of the way the prices we see in the market coupled with the price of Better Collective.
You're a perfect example of someone staying in one industry for decades, can build a huge business. Not too many people are doing this. What is your thought process behind this? Staying in one industry versus maybe following trends, investing in other businesses outside of this main thing. What are your thought process?
So something we back to Christian and I, we agree on fundamentals such as we think long term and believe that sort of from a like compounding perspective, like long term is where we really see sort of the big lift that you have a hard time seeing and considering if you just look, say, 10 years. And I listen a lot to different podcasts, and it's just my favorite is the Acquired podcast that I listen a lot to, and there they had an episode on, I think it was one of the big US venture capital firms, and they described they had been an investor in Apple from the early days. And what was just a big takeaway for me was sort of the description of, yes, they sold way too early. And then you considered when was the biggest sort of value lift in Apple and where did it really take off? It was actually sort of, you saw a huge lift when you got to the point where it was from 20 to 30 years or potentially like 30 to 40 years in the compounding effect. And for me, that was really interesting because you look at a lot of companies and it's actually like, it's unbelievable the kind of effect compounding has when you get to that level. So back to your question, I think we've been fairly aligned that, okay, we're in an attractive industry, and if we can keep on building in this industry, we will see that like very, very strong effect when we get to the outer years. And then at the same time, I'm curious by nature. So we have gotten ourselves involved in other stuff and taking part in creating other companies, but it has been outside of Better Collective. And we have now, Chris and I, a family office together where we drive initiatives. We have a small team there working with that. So you can say that curiosity and need for something outside is being taken care of in a different vehicle. So we can stay focused in Better Collective on the industry we're in.
You mentioned 55 to 75 million euros in free cash flow. This is wild. So what keeps you up at night?
If from the risk perspective, you mean what keeps me awake at night, or
just let's take
getting up in the morning.
Let's take like for the past month. What have been your worries and maybe things you've been stressed out or business wise?
We are in an industry where I have many times said quarter in Better Collective and this industry is probably comparable to a year in a more traditional production company. So there's a lot of speed, and from an organizational perspective and the development of the company, we have in the last 6 months, had a big focus on that. So that's sort of what has been on my mind more recently, and something where you always need to develop, but it also requires the courage to make decisions and changes where you believe it's for the greater good of the company and setting the company up for success long term. So that's sort of what has been on my mind more recently.
And when it comes to managing your ego and humility, I mean, leading such a large company, it must come with like moments of ego that we made it, we've come so far. How do you keep yourself grounded?
I have actually not, and I think the same goes to Christian. We have not thought about it like that. We've always been very much about sort of the next milestone, the next. So we got to this point. Well, wow, that allows that we can actually get to this the next level, and I think that's the mindset we have. Like we are not content. We aspire to do more, and I'm also very realistic and honest about that. It's not because of me that we have succeeded. It's really because of all the great people in the company, a lot of factors around us. So there's so many variables in this equation that has led to us being where we are. So I feel sort of I'm just one of those small variables in that big equation. So I should not basically get ahead of myself and think that my variable means so much more than any other variable in that equation. And I'm also one that I always highlight luck. Don't underestimate luck and timing when you develop something that becomes successful, because I can look back and then I can pinpoint times where had things not gone the way they did, and it has sort of gone the other direction, I'm actually not certain we would have made it here. So, I'm very respectful and mindful of that. There has been times where, it was good time. We were lucky also. And it's definitely depending on the skill sets of so many people in the company. And so I think with that mindset, which I honestly feel, it's not that difficult to stay grounded, because you just sort of acknowledge that this is so much more than me.
Okay, so thanks a lot for doing this. We have 1 minute left. 2 quick fire questions. What is your favorite book, and what's the best investment advice you've ever got?
So my favorite book, and it's such a tacky title, so I'm also a bit not too proud of saying that title, but the book is great. How to Win Friends and Influence People by Dale Carnegie, which was more or less the first book written on human relations, and it's actually soon 100 years old. But if you really manage to incorporate sort of the thinking and mindset of that book, it will give you a lot of tailwind in your interactions with people. And I think that is just something that will set a lot of people up for success. So I read it at the right time of age. I think it was just 22 or something. And it really sort of gave me that idea of always remembering to take another person's perspective, and don't try to force your opinion or objective on the other party. Try to, be respectful and mindful of the other. Put yourself in the shoes of another. That it just goes a long way. And investment advice, I think it has to be think long term and be decent. Like sort of back to this very fundamental. It sounds easy, and I think when I got that point, and I was remembering you have to be respectful and decent in your interactions. I underestimated the effect of that in long-term company building.
Okay, thanks once again for doing this. I know you gotta go, so I really respect that. So have a great day. Thank you.
Thanks, my pleasure.